Hi everybody, my name is Jason Gold and I'm back with another episode of Investor Reacts. In this episode, we're going to be talking specifically about Google's parent company, Alphabet. And more specifically within that, we're going to be talking about how investors don't actually understand how companies work in real life. So let's talk about investors. They have one job in life. Their job is to make money. Whatever they do, however they do it, all they need to do is make money. Now, some investors have absolute performance strategies where they need to make money no matter what happens in the market. Others have relative performance strategies where they need to make money relative to a benchmark. They just need to outperform it. But no matter what, the thing that they care about the most is simply performance. Now, many people work at real companies, and that's not to say that fund managers and analysts aren't real workers, but their companies are very different than the operating companies that they invest in. See, operating companies have employees with real incentives like getting promoted or making a product or getting along nicely with other people. That's not what happens at an investment firm. And I'm not here to say that the corporate culture at investment firms is good or bad. I'm just here to say that it's very different from what happens at regular companies. And company managements need to understand this relative disconnect. The disconnect being that people who work at investment firms know how investment firms work and they know how to make money. What they don't really understand is how regular companies work and how there's very often people behind this product and these services that they're investing in, and that those people have jobs, they have incentives that are different from what they're used to, and there's a lot that goes on behind the scenes to motivate people and to get them to do the job that these investors are actually investing in the companies for. See, these operating companies have people that care about corporate culture. They might care about the company picnic. They might care about pleasing their boss. They might care about getting promoted. These are all regular good things for people to care about. But investors care about one thing, and that's making money. And how do they do that? They look at spreadsheets all day long. Every one of their investments is a spreadsheet. And the spreadsheets can be really cool. They can discern really neat things like product growth and margins and incremental margins and things that are really insightful about a business. I'm not here to say that looking at spreadsheets is good or bad. I'm just saying that only looking at spreadsheets is generally what investors do, and they don't have the real world experience of working at a company to know what goes on behind the spreadsheet. So why are we talking about this? I'm not ragging on investors. In fact, I was an investor for 20 years, so I understand how they think. But it wasn't until I came out from behind the spreadsheet and became an operator at a company that I truly saw this disconnect. And the reason I'm here talking about this today is that company managements need to understand that investors don't fully understand how their businesses really work. They might be really smart. They might ask really insightful and smart questions. But at the end of the day, 99% of them haven't worked at a real operating company. And so the onus is on you to explain many of the things that are actually happening. So why is this important today? What was the catalyst that got me to make this video? Well, Google came out with an announcement a few weeks ago talking about cost cutting. And in the headline of the article, they talked about reducing the days that the baristas were on staff. They talked about reducing the amount of sticky tape and staplers that they had. And they talked about reducing the amount of gym memberships that they were willing to give people. And then the emails started to come in from my friends who are still investors. What is going on at Google? Do they really think we're going to buy that reducing the days that the baristas are on staff is actually going to make a difference? And look, I'm not here to talk about whether or not reducing expenses for sticky tape, baristas, and gym memberships and staplers is actually going to make a difference to Google's stock. I also have no idea if it's going to impact their financials. But what I do know, investors don't understand how monumental a task it was for Google or any company of that size to make such a sweeping set of remarks that they actually put out a memo from their CFO talking about it. Investors just look at their spreadsheet and they say, how does this affect my spreadsheet? How does this affect their competitive nature? How does this affect their moat? Will it affect their AI? Doesn't Google have bigger things to be worried about? The answer to those things is irrelevant to this conversation. What this conversation is about is that people don't understand, or investors don't really understand, all the human beings that work at Google. And what decisions Google had to make, how much brain damage must have gone into thinking about what do we cut? When do we cut it? How much do we cut? How do we communicate this to people? Because Google is a company of people. And those people have incentives and motivations, and not having sticky tape and not having staplers and not having baristas might seem ridiculous to investors who just look at spreadsheets all day, but it is consequential. It is major to the people that work there because there will be downstream implications. And all of the work that Google had to expend, all of the time and effort that they went in, the meetings that they had to make these decisions are significant. All investors saw were these headlines and the silly articles that went with it. And they joked about it. They made fun of Google. But what that showed is that they just don't understand how companies actually work. Because remember what I said at the beginning, investors focus on spreadsheets. And it's up to management to understand the disconnect between understanding spreadsheets and understanding companies. And so good management teams and good investor relations people will explain these things to investors in human terms so they understand what it means. You need to educate investors. You need to show them how these decisions that you're making actually work for the company and what the implications are. For example, say you introduce a new product. What investors are going to do is they're going to type into their spreadsheet the new product row, and they're going to come up with numbers and then sequential growth or year-over-year growth numbers out into infinity so that it populates their model. It's up to you to explain to them how does sales enablement work? How does sales incentives work? When do those kick in? Could there be Salesforce turnover as a result of changing those incentives? Investors won't know necessarily to even ask those questions. It's up to you to explain how that whole process will work. What if you change sales incentives around selling a new product versus an old product? People need to understand, investors need to understand what happens to the deals that were already in flight. Do salespeople stop working on those deals to start working on the new one? Explain to people that despite making new sales incentives, sales might actually dip as salespeople figure out what to do. You know, when I was an investor, I used to hear people say all the time, oh, sales teams are coin operated. But I bet if you ask them, they don't actually know what that means. Most investors can't really explain how a salesperson does their job, how much money they make, how commissions actually work, or how they're motivated to do what the company wants them to do. That is your job as company management to explain these things in great detail to people who've never worked at an operating company and just sit behind spreadsheets all day. Remember, investors don't work at normal companies. They work at investment firms. What's normal to them is totally different from what's normal to you. So you have to explain things over and over to them in human terms to help them understand. And if you don't, they're just going to want to know, why aren't you growing faster? Why aren't your margins better? Why isn't the sales team doing what they're supposed to do? I've built a sales productivity model, that's one of my favorites, where I've got ramped salespeople and ramping salespeople, and your numbers don't seem to match what my spreadsheet says. You need to explain to them why that's happening. Once you explain this to them, they will understand, but you have to go out of your way to explain how the changes that you're making at your company have an impact on human behavior. And after all, it's the human behavior that drives sales at any company. And the worst thing that you can do is make changes at your company that have some risks and only talk about the upside. I've had clients that talk only about changing sales incentives and how great things are going to be. But then they missed the next quarter because the sales team paused while they were going from one incentive to another and they weren't quite sure what to do. So be overly communicative with your investor base. Explain why what you're doing is the right thing to do. Explain how it actually will play out in real life or how you expect it to at the human level. And remember, investors are just looking at spreadsheets. Help them understand how this plays out in the real world. That's it for now. Thanks for tuning in to another episode of Investor Insights. I look forward to seeing you back here next time with another episode soon.